Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Dr. Russell Rhoads, Associate Clinical Professor of Finance at Indiana University, to discuss the impact of a three-day holiday weekend on the options market. Russell, it's great to see you again. Welcome back to Trade Talks. And of course, we have a three-day weekend in observance of Juneteenth, and this usually has an impact on volatility indices. Why is that, and what is the impact?
Well, there's always a weekend impact. It's very slight during a normal two-day weekend, but I've run numbers in the past, and you're more likely to have a down day in vol Q on a Friday than any other day of the week. And then you're more likely to have an up day on Monday than any other day of the week. And that's because volatility indices are calculated using calendar days. So when we come up on a two-day, 2 days that are off, one of the ways that the market makers will adjust their option pricing for 48 hours of no action is to reduce their implied volatility inputs on their models, usually about this time, about midday or so going into the close. And that's on a normal Friday. It's just accentuated when we've got 3 days off in a row, like we've got coming up this weekend. Is
there something specific about the Juneteenth holiday that you're keeping an eye on?
Well, this is what's unusual with the Juneteenth holiday, which is relatively new. If I remember correctly, it's almost like it was approved and we celebrated it just a couple of weeks later. So there wasn't a whole lot of knowledge ahead of time that we were going to have a long weekend. Now we know it ahead of time, but also, what's interesting about adding a holiday in the middle of June in conjunction with the July or the Independence Day, July 4th holiday is now we've got these periods where we've got two holidays over like a 30-day period where the implied volatility is not just being impacted by one normal 3-day holiday, it's being impacted by two 3-day holidays. So volatility indices across the board, I'm looking at vol Q right now, which is a bit under 18. They've been under some pressure due to market factors, but I also think over the past week or so that we've got two holidays sort of getting in there with the calculation of the various indices, that's impacting it as well. The only time of year, and I feel like I've spoken about this for so long, I'm almost associated with it, but the only time of year that we really do see this sort of impact or have historically is in December when we've got Christmas, New Year's, and MLK. So we've got 3 holidays in there, and typically you can see in the volatility futures that there's a little bit of a dip of expectations in December, but you can also see that volatility indices, the average price is typically lower in December than most months because of that extra holiday effect as well.
And if I remember correctly, MLK and Juneteenth, they're the Monday after triple witch, quad witch, whatever you want to call it, options expiration. Or not that, but just regular rate expiration. June, it'll be after triple witch, so you have to factor that in as well. Is there a boost to vol Q after the long weekend?
Oh yeah, and that's like I mentioned just a second ago. On Mondays, we're more likely to see a volatility index move higher. On average, I think the Monday after or the day after a 3-day weekend, because it of course can be a Tuesday, but the day after a 3-day weekend is on average the best day on a percentage change for vol Q when you compare it to traditional Mondays after a 2-day weekend, et cetera. But yeah, we definitely see a boost for volatility indices right after a long weekend, much like we see a headwind going into those.
All right. Appreciate the insight as always. Russell, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.